Revolve Renewable Power is a developer of solar, wind, and battery renewable power generation projects in the US, Canada, and Mexico. The company just reported profitable fiscal Q3 results, driven by 472% growth in revenues to 1.9 million. CEO Myke Clark and CFO Tanya Ontiveros are here to review the quarter. I'm Martin Gagel with Market Radius Research. Please remember this is neither recommendation nor investment advice. We're here to learn about the company. Tanya, Myke, welcome and congrats on a solid quarter.
Excellent. Thank you.
Thank you.
All right, why don't you go? You've got a presentation, a brief presentation. Why don't you run over that, and then we can ask a few questions and have a conversation on the quarter.
Excellent. Great. Thanks, Martin. And thanks to everyone for tuning in. As you mentioned, great quarterly results for us, a profitable Q3. And let's dig into some of the details as well. Of course, we have a disclaimer here with respect to some of the information. You can also take a look at this on our website. It's got our full corporate presentation and this specific Q3 presentation as well. As a bit of an overview, for people who may not remember, our first time to the story, fast-growing renewable energy developer, owner, and operator of projects. And essentially, we take developer fees from larger utility-scale projects, recycle that capital into projects that we own and operate, and then generate long-term recurring revenue for the company. Really strong operating foundation, 12 megawatts of operating assets right now. Almost 7 million of revenue in US last year, profitable year last year, and a large pipeline of development stage projects as well. And, quickly, why are we in this market? It's all about growth with respect to electricity. The demand for electricity is growing everywhere. We really like the three markets in North America, driven by electric vehicle adoption, energy security concerns across all three countries, data center growth, manufacturing growth. And so you see a lot of demand for the product that we sell, which ultimately is electricity. The company is based on our project development pipeline, essentially. So we have operating projects, as you can see here. We have late stage development projects in Mexico, the US, and in Canada. This year is really an inflection point, if you can describe a year as such, because a lot of our projects have moved from mid-stage to late stage in terms of development, and they're ready to get to that ready-to-build stage, and then ultimately up and operating. Then we also operate some smaller solar projects, mostly in Mexico. We describe these as distributed generation. These are usually rooftop or for businesses, individual businesses, as opposed to utilities. That part of the business is growing as well because what we offer is low-cost electricity so that businesses can essentially reduce their operating costs. And so for us, the Q3 numbers, great numbers, 1.9 million US, give or take, in terms of revenue, a massive increase over Q3 2024. Quite excited about that. That was a combination of recurring revenue from contracted projects that we own and operate and project sales, so development stage project sales as well. And we can dig into that breakdown in a bit. But net income, so profitable to the tune of 137,000 US, which is great for a company that is growing as fast as we are, and in the space that we're in, to be profitable at this stage. I think we're a unique investment opportunity because of that. And that's really the basis of the company story and pitch, is that a strong foundation of operating assets combined with larger projects that we sell. This is all based on increased generation. So the projects that we own and operate, we continue to bring new projects online, generate more electricity, and generate more revenue from the sale of that electricity. 12 megawatts operating capacity, actually closer to 13 megawatts. Again, these are run-of-river projects, wind projects, solar projects that we own, we operate, sell power to a customer. And then, as I mentioned, in terms of other progress, business progress during the quarter, we've advanced several large projects that we anticipate being at that ready-to-build stage by the end of this year. So in terms of the growth of the company, not just top line, bottom line revenue, but the underlying asset base is growing significantly as well. I'll touch briefly on the recurring revenue piece. So I noted that, in terms of our revenue, we have asset sales or developer fees that were paid for larger projects that we wouldn't be owning and operating. And then we have recurring revenue. And this is a bit of a snapshot of the recurring revenue growth. And what this shows is that as we continue to grow and add projects into our pipeline, we increase generation, We increase revenue. These are all contracted from anywhere from 9 to 25, 30 years. So long life assets that generate recurring revenue for a significant period of time. And now I'll let Tanya jump in here, and I'll stop talking at length. And maybe if you want to run through some of the details there, both the operating results and some of the balance sheet items, Tanya.
Yeah, excellent. Thank you, Myke. So for the quarter end March 31st, 2025, we had significant revenue, which increased to 1.9 million. And that was driven by the increased recurring revenue, which Myke just mentioned, almost $585,000. And the monetization of the Mexico CHP project that brought revenues of $1.3 million during this quarter. We also had significant gross profit and gross margin improvements during the quarter, and the general and administrative expenses remain relatively stable at 1 million as compared to 956,000 in the prior year period. We had net income of 137,000, which is a huge increase in comparison to the same period last year. And when it comes to the balance sheet and financial resources overview, as of March 31st, 2025, our total assets decreased to 15 million from 18 million at June 30th, 2024. And this was primarily due to depreciation of assets and as well as a reduction in cash used for general operating activities and project development costs. Our current liabilities were reduced and long-term liabilities increased following the repayment of a 3.9 million Canadian dollar loan with our royalties. And there was a subsequent Vancity Capital Corporation loan related to the acquisition of the assets of the Wind River Power Corporation acquisition.
So if people are looking at the balance sheet as well for us, we have debt on the balance sheet, but it's important to note that is non-recourse debt. So it's usually housed at an SPV at the project level. So this is not taking on debt for the operations of the parent company. It is project level debt, which is very standard within the industry. So people shouldn't be scared away by that. In fact, the more debt that we have, non-recourse debt that we have, it means we have more and more projects that are operating, because those projects can carry anywhere from 60 to 70, sometimes 80% debt on those projects. So really good overview, Tanya, and to the team at Revolve. Very happy with the quarter 3 that we just wrapped up.
What always strikes me with your business is you have so many different moving parts and so many different assets that you manage. I guess not so much of a question, but talk about your general strategy on you have assets, you're buying assets, you're selling assets, you're developing assets. What is your strategy on how you perceive sort of where to choose your opportunities? There was a combined heat and power project that you sold at a profit to what you bought it for just recently. Talk about your strategy on really as an asset manager, how you do what you do.
Yeah, absolutely. So it's kind of critical to our business, obviously, and sometimes it's a little bit complicated because there are, as you note, a few different moving parts with respect to it. But essentially what we want to do is the model is we call it a 3-pillar approach, but basically it is we want to either develop and sell, develop and own, or M&A, so acquire project portfolios or project assets. For develop and sell, essentially what we're looking at is very large projects, 50 megawatts and above, so capital costs of 50, 60, 70 million and above, that at this stage of our development, we likely wouldn't be able to own and operate ourselves because of the cost, the cash involved. So we sell those for a developer fee, much the same in the sort of junior major in the mining space, get it to a certain stage and sell it when it has the most value. So that's an investment along that development path of projects, get them to a stage where someone else wants to come in, take over, build it and own and operate. We take a developer fee and oftentimes see 4 to 5 times the return on our capital for that. And it takes a few years to get there. The develop and own model is for smaller projects. So these are projects up to 50 megawatts where we do the development, but instead of selling it, we go through the process of building it and then owning and operating it and generating that long-term revenue stream. So those are the 2 sort of key business models for us. When you layer on M&A, that is really opportunistic. So if we look at development pipelines, people sell those all the time, early stage projects, late stage stage projects, it really depends on the company that's selling them and whether or not they are looking to exit it because it's a non-core market or it's a non-core asset. They're just really not interested in continuing to develop it. That if we're judicious, we can move in and see these opportunities, take advantage, pick them up cheap, do the development work to add the value, and then sell them for a significantly increased return. The sale and the timing of the sale of those is all really up to sort of our analysis of what the market looks like generally. Are people paying a premium for those assets right now? Are they only buying them at a discount? Obviously, you want to sell them when the market is frothy and when companies are looking to pay a premium. And when we've done a certain amount of development work to increase the value of the asset. So there's a lot of criteria that go into when we buy and sell them. We obviously, I mean, to say buy low, sell high is obviously a simplistic explanation, but it's a very realistic one. What goes into creating the value so you can sell high is our underlying business. Creating value by assessing the opportunity, doing the due diligence, doing the work on the ground to permit the project, go through environmental assessment if required, putting together the financial model, doing everything you need to do to make a project a reality. And at some point along that development path, you sell it when it makes the most sense.
You're obviously, as you develop this model, you grow more and more of your energy producing assets, and that's going to be the more stable part of the business, while these other ones are, you get blips up and down of really strong quarters where you have an asset sale and so forth. How you've given the model in the background, how should investors look at it for the coming quarters? You don't give guidance because often, you just don't know when things are going to come together. How should the investors, let's say, look at the remainder of the year in terms of growth and strength?
Mm-hmm. There's a few different ways to look at it. We look at it at our assets, so our portfolio of projects, and think of that long list of projects that I showed and people can see on our website. Those all have value. We could sell almost any of those projects at any given time and realize some cash if we wanted to. Does it make sense? No, it doesn't. You want to make sure that you're adding value along that path. And so for us, the question becomes one of, when do you make that sale? From a revenue perspective, it contributes to it a little bit, but if you look at Q3, 1.5 million of one-time sale proceeds versus $700,000 of recurring revenue, you're right that recurring revenue is growing, but the asset sale can be lumpy. So you're right, we don't predict it, but I would look at it on a year-over-year basis, definitely. Ultimately, though, I would look at the assets that are the foundation of that revenue, because next quarter we could sell a project and realize $5 million. That's definitely not guidance, right? Or we may not sell an asset at all, and we would only have $700,000 of recurring revenue, which is what we saw in Q2, I believe. So there is a mix. I think when people do their analysis of the value of the company, I would take a look at all of the projects that we have under development, the late stage projects that we have under development that we hope to own and operate, which is about 100 megawatts, which gets us very easily to the sort of 15 million revenue number. And we've disclosed that as sort of a midterm target for us. If we get those projects across the line, I mean, it's just straightforward math. And so the line to get to increasing revenue is pretty linear, right? And then we'll drop in those asset sales as makes sense in terms of the value and where they are on the development path. But you're right, sometimes it's difficult for us to make the projection and tell people. But I would say that that we are generally always in the market of buying and selling. That is part of our business. So people shouldn't expect one sale every 5 years. People shouldn't expect one acquisition every 5 years. It's what we do on a regular basis. And if you look at our history, we've acquired 3 companies. We've acquired operating assets in the past. We've sold multiple projects at multiple stages along that path. So we've kind of done it all. And so people shouldn't be surprised if we sell another project in Q4. They shouldn't be surprised if we don't sell a project in Q4. But the long-term trend is absolutely going in one direction, and that's up.
Yeah, so you've got your assets, and they either get monetized by creating power and selling that power, or by selling it off to someone else to generate the power themselves or finish the development of it?
That is 100% correct. That's exactly the model. Yes.
Yeah. On your power producing assets, is there a lot of seasonality? And I'm sorry, as you get bigger, I presume each specific asset that maybe has its own unique seasonality, they'll get sort of balanced off. So as you get bigger, it'll become
Yes.
a flatter production line through the year.
Yeah, it definitely right now it is even the recurring revenue is a little bit lumpy because of a couple of the types of projects. With solar, it's pretty steady, generally speaking. I mean, you get more generation during the summer. Obviously, it's sunnier and a little bit less over the winter, but it's still relatively steady. For wind, depends on the jurisdiction and it depends on where you're operating. For run-of-river, there's a seasonality to that. In the spring and early summer during freshet, when all the snow is melting, that is when you're generating a lot of the revenue and a lot of the generation. So there is definitely some seasonality to it. As we grow, we're going to increasingly see battery storage with these as well. Now that won't do anything with respect to seasonality, but it will improve the economics potentially of these assets as well. I don't know if you wanted to add anything there, Tanya. You know, it's something that we budget for without a doubt. So our financial model obviously goes out for the life of the project. So we have a good understanding of what that looks like. And maybe you want to touch on that, Tanya.
Yeah, no, I think I do agree. I think when it comes to the financial models, we get to track that seasonality for every project asset, whether it is in Mexico, the US, and Canada. And as you mentioned, Martin, as you're having more projects, then you would have a more flat production number with respect to the different technologies that we're involved with.
All right. The last several months since we've talked with you last have been very tumultuous with tariffs and then interest rates and all of those actually. And while tariffs don't directly impact you as you don't sell power across any borders, interest rates affect asset prices and then tariff affects equipment that you use to develop these projects. How have these multiple and economic uncertainty affects interest rates or maybe investment decisions? Can you talk about specifically each of those topics, or generally how has that affected your U.S. projects, or maybe equipment prices have been inadvertently affected in Mexico and Canada as tariffs on Chinese equipment have gone up? Anyways, there's a lot going on there. Can you sort it out a bit for us?
Yeah, and when you bring it up, you have to laugh, otherwise you cry, because you know it's not from our perspective, from our business perspective, the impact is pretty minimal right now. You know, touch wood for sure, because our projects in the US are not at a construction stage, so we're not procuring materials for projects in the US right now. It would be challenging to price a project in the US right now. If you were looking to procure materials and build, say, by the end of the year, I think that would be a challenge. We're not in that position. You know, the projects that we have in the US would be potentially ready to build by the end of this year, but not into construction until next year. And so I think by then, you know, the hope is that things will smooth out a little bit. We'll have a little bit better understanding in terms of what the overall tariff situation looks like. With respect to Canada and Mexico, not really seeing anything in terms of materials pricing in Mexico. You know, we're not sourcing from in the US. There's some volatility in terms of supply chains, without a doubt. But from a pricing perspective, it's not impacting anything significantly for us. Again, in Canada, the latest stage project we have is in Alberta that we would look to be ready to build by the end of this year. So not procuring right now for a 2026 build, but late this year. So, you know, I'll sort of park that one and say, we'll see where pricing gets us, where we're at the end of the year. But having said that, though, you know, at the end of the day, all these tariffs do, and I think we've seen a lot of press about it, generally speaking, is that the cost gets passed on to the customer. You know, there's volatility, and even within the U.S., there are the budget bill that's looking to make its way through the Senate right now has cuts to tax credits for renewables. Whether that stays in place, I don't think it will, but we'll see. Ultimately, this will get passed on to the consumer in the form of higher power prices. It has to, because power is necessary. The demand is increasing. And really, the only types of new generation you're seeing to any great degree right now is solar and wind and battery storage. There are no new coal plants. Nuclear plants, take a view on what you feel about nuclear. They take 5-10 years to permit and build, and they're expensive. And so this is why we love this industry, that even with all of this volatility, we know the demand is there, and we know the product that we have makes sense because it's cheap. And so we have to navigate it, right? We don't hedge anything in terms of currencies or anything like that, given our size. But as we continue to grow, our geographic diversification will benefit us even more. If we want to put US on hold for 6 months, which we're not doing at this stage, but if we wanted to, we could focus all of our effort in Canada, focus, all of our effort in Mexico. It's great for a company this size to be geographically diverse and also technology diverse, right? So for whatever reason, the administration does not like wind projects in the US. We have wind, yeah, but we also have a lot of solar projects, same in every jurisdiction. So we like that diversification from a technology perspective, but also from a geographic perspective. So I would say the biggest issue from all of the tariffs and everything that's happening right now is really in the markets, the public markets, and that there's volatility, and sometimes people are scared with respect to risk. They see a company like ours, which is small from a market cap perspective, and think maybe there's increased risk there. But if you look at our underlying foundation of recurring revenue, I think this is, the time to invest in companies like ours that have a track record, that have a business model that allows us to weather these types of situations and have recurring revenue. I mean, that's what you want, right, in these types of situations. So I think we're in a really good place. But we monitor it very closely, given the potential impact in the US of various policies that can pop out, day to day.
Yeah. You mentioned before, when you buy and sell assets, you wait for sort of you're opportunistic, and when there's like a buyer's market or a seller's market. Can you characterize the market right now? Is it a buyer's market? Is it a seller's market? Is it kind of on pause? What's your sense of what the market's like right now for projects?
So it depends on the type of project. So I would say early mid-stage development projects that have a lot of work still to be done on them. I don't want to speak for the entire market, because bigger players, it's a different consideration for them. Like, they may be buying operating assets. It's just a cost of capital sort of conversation. For us, we look at markets that we're interested in, and can we pick up a portfolio of projects relatively cheap? And we're seeing a lot of those opportunities. Okay. Is that because of Trump and the White House in the US? I would guess it is partly because of that, definitely. But we're also seeing it in Canada. The nature of this type of development is that you usually see developers take them to a certain stage, then a bigger company steps in. They take them to the next stage, a bigger company steps in. We're kind of in the middle, right? Ultimately, we want to be the big company, but we're in the middle right now. So we see a lot of smaller developers, people who have one or two projects, who are looking for that company to take it to the next level, take it to the next step. And we see a lot of those opportunities come across our desk definitely right now.
I think you covered the quarterly results very well there. We talked about the bigger picture. Anything else to sort of highlight before we wrap it up here?
I think the only thing right now is that if people take a look at our website as well, you'll note and have seen previous releases, we have an acquisition underway right now as well. So we're actually in due diligence on the acquisition of a 10 megawatt operating wind project in the US. And so again, this not subject to tariffs, no issue with their contracted project, non-core asset for the seller of the project. For us, it's a great project size, so it would not quite, but almost double our installed capacity. It would significantly increase our recurring revenue. We have a deal in place for a big chunk of the debt on that project already as well. So if people want to take a look at that. So I think we're doing a lot of things on the M&A front in terms of pipeline, but also this operating asset that we're looking to acquire as well, I think is quite exciting. And one of the things we don't really focus on in the Q3s because it doesn't impact the numbers. But longer term, it's the type of project we'd like to acquire more of, and we're in the process of finalizing that due diligence and finalizing that transaction right now.
Would you expect that to happen in your fiscal fourth quarter, or could that spill over into your next fiscal year?
Yeah, so we disclose that the target is to close that by the end of our fiscal. Yes, correct. If that changes, obviously we'll let the market know, but that's what we disclosed. Correct.
All right. Okay, great. Well, thank you for that update. You've been busy. Appreciate the time, and have a great day, and talk to you again soon.
Thanks, Martin.
Thank you.